Ladies and gentlemen, thank you for joining us today and welcome to our firm's Investing in India program. My name is Prasenjit Chakravarti and I am partner in Ketan's Corporate Practice Group. I would like to extend a very warm welcome to every one of you wherever you are around the world. Investing in India is a webinar program curated especially for existing and prospective foreign investors in India and their advisors to enhance understanding of key issues in doing business in India. The program seeks to cover over time all the issues of interest to our target audience. In today's session, we will be examining the different business structures which are available to foreign investors in India to choose from, including which one is appropriate and which one is not, along with reasons for that and the tax implications for each model. We hope to provide valuable insights to effectively support your Indian investment decisions. On this slide is the agenda for today's webinar. If you do have questions, please submit them using the facility provided in the webinar portal. If you do not cover all the questions during this webinar, we will separately respond to them after the webinar over email. Also, please note that a copy of this presentation along with summary notes and a recording of this webinar will be sent to you over email separately as a matter of course. Let me now introduce our speakers for today to you. All registered participants should have already received an email with resumes of both our speakers and myself, so I will keep the introductions brief. Our presenters today, Mr. Sameer Shah, a corporate partner in our firm, and Ms. Ritu Shaktawat, a direct taxation partner in our firm, will be presenting today. They each bring a wealth of extensive experience in advising foreign clients on their investments in India. So, I would like to now invite Sameer and Ritu to present.
Thank you very much, Prasanjit. On the slide before you is the agenda for today. We will be covering each of these topics through our presentation. Next slide, please. As Prasanjit explained, we will try to cover the various business structures that are available to foreign investors in India. And it is necessary, ladies and gentlemen, to evaluate any structure from 4 different perspectives. The base case would, of course, be regulatory requirements and whether the structure fits the requirements from a business perspective. It is very pertinent to ask whether all the business needs and operational requirements of flexibility are being met. Once the business is up and running, it will generate revenues and hopefully very quickly it will start churning profits. What is the tax cost of that? And what would be the after-tax profit that businesses can take out from India? In any event, business inherently involves the assumption of risk. And as they say, with greater power comes greater responsibility. In my personal experience, the more flexible the structure, the less likely it is to provide a good amount of risk cover. And the central thread in all of this has to be certainty to be able to predict outcomes. Next slide, please. As I said, there are various forms of business structures through which one can operate in India. These would also include sole proprietorships, partnerships, cooperative societies, joint Hindu families, etc. But the options that are available to people such as yourselves who are intending to set up businesses in India and have prior experience outside India are a little more specific. For a non-resident or multinational such as yourselves, you only really have these business vehicles to choose from, and we will cover each of them in more detail in our subsequent slides. Next slide, please. Let us start with incorporated entities and wholly owned subsidiaries in particular. We do have joint ventures which we will cover later in the presentation. To begin with, we mostly see multinational companies setting up either a wholly owned subsidiary or a joint venture in India. And such a company can be one out of 2 types. It can either be a private limited company or a public limited company. These companies are separate legal persons with the ability to own their own assets and answer for their own liabilities. As a result, shareholders' liabilities are limited to the extent of any unpaid capital. As the name suggests, a private limited company must restrict the number of its members and also the transfer of its shares within the members. It cannot invite the public to subscribe to shares or extend deposits to the company. It is interesting that while you can incorporate a company in any specific state or any other specific location, but it will have the flexibility to conduct business operations anywhere in the country. And except in certain sectors where there are time restrictions to the extent of the capital which is locked in, mostly capitals and dividends of shareholders are freely repatriable. Bearing all of this in mind and gauging on our prior experience, the preferred form of business vehicle in India is usually a private limited company. Unlike a public limited company, a private limited company is subject to far fewer compliances and disclosure requirements. Also, you need only 2 shareholders to start a private company, but a public company must have a minimum of 7 shareholders. Mind you, Indian law also allows for one-person companies. Unfortunately, at this time, they are not open to foreign investment. Funding such private companies can happen either through equity or equity-like instruments such as compulsorily convertible preference shares or debentures. It can also happen through debt. Funding through debt has certain additional compliances and end-use restrictions, but these restrictions have been gradually liberalized over time to allow parties ever more flexibility, and they are likely to be liberalized even further. As our partner Atul Pandey has already explained in one of our earlier webinars in the series, most sectors now allow for 100% foreign direct investment. There are but a handful, and I stress a handful of sectors that still require a local partner, which we will discuss separately when we discuss joint ventures. However, a wholly owned subsidiary is therefore now an ideal choice. Having said this, I should highlight, and one must be mindful, that winding up and closing a private company can be a very cumbersome and very time-consuming affair. And therefore, one assumes that a sufficient level of business case has been built in prior to actually incorporating a subsidiary. Let's move to the next slide, please. I can share a positive experience of IKEA in doing business in India through multiple wholly owned subsidiaries. The Swedish home furnishings giant brings well-designed, functional, and affordable home solutions to the Indian market and opened its first brick-and-mortar store as far back as 2018. Their business primarily falls within the retail trading sector, which has only gradually opened up to foreign direct investment. It now stands at 100%. The commitment demonstrated by IKEA towards meeting the local sourcing requirements that are applicable to this sector. They've partnered with local suppliers and craftsmen, and not only have they ensured cost effectiveness to their products, but they've also contributed to the local economy. What is most interesting is that their investment is not restricted to brick and mortar alone. They have also made significant strides in e-commerce, reaching customers in multiple cities through their online platform. This omni-channel strategy has amplified IKEA's reach and accessibility across the nation. I will now request Ritu to describe the tax considerations of a wholly owned subsidiary.
Sure. Thank you, Samir. So when we talk about tax costs of a company form of structure, there are essentially 2 parts to it. One is what will be the tax that will apply to the corporate profits of the company or income of the company, and what will be the tax on profit extraction from the company. So in terms of corporate tax rates under Indian law, the highest effective tax rate is 35%. When I say effective tax rate, I mean base tax rate plus surcharge plus cess. And for simplicity, I'll be mentioning the highest effective rates. Small and medium-sized companies which have a turnover of a prescribed threshold, which is 400 crore Indian rupees or roughly 46 million US dollars in a preceding year, those companies are subject to a 29% corporate tax rate. Companies are also subject to minimum alternate tax, which is MAT. It is based on adjusted book profits of the company, and the MAT rate is 17.5%. So one needs to pay higher of the two: general corporate tax rate under general provisions, or minimum alternate tax under based on their accounting income. There's also a concessional rate that's available to companies. It was very recently introduced under Indian law. It is 25%. It is available to all companies, but companies need to forego certain special deductions and exemptions to avail this rate. This was introduced as one of the simplification measures where government has phased out deductions, exemptions because of the prolonged litigation, interpretation issues, gray areas. So to simplify the tax regime, government is phasing out incentives and has slashed the tax rate itself so that overall the tax regime moves towards more and more simplification. If we can move to the next slide, please. Now coming to profit extraction or return on investment. So dividends on shares, where profit is distributed in the form of dividends to shareholders, it is taxable income of the shareholders. What it means for non-residents is that under domestic law, the dividends are taxable at an effective rate of 22-23%. And non-residents would also be able to claim treaty benefits. So generally, if we look at India's tax treaties with jurisdictions around the globe, the tax rates on dividends vary between 5% and 15%. So under India-Mauritius tax treaty, it could be as low as 5%. Under India-US treaty, it could be 15%. So there could be tax efficiencies depending on where the shareholder is located. Now, this wasn't the case until 2020. Until 2020, companies were subject to a distribution tax of 20%, and the income was exempt for the shareholder. What it meant was that shareholders couldn't claim credit of the taxes that the company is paying on the dividend because it's company's tax, not shareholders' tax. And non-resident shareholders couldn't even rely on treaty benefits. So in those days, a high corporate tax rate coupled with a high distribution tax on companies made a corporate structure tax inefficient. But now all that has been addressed. We have different structuring analysis now, where corporate tax rates have also gone down and distribution tax has also been eliminated. Coming to debt funding, if let's say shareholders do not want to fund the Indian company solely by way of share capital infusion and lock the money in India, then the funding can also be by way of debt. And depending on whether the debt is Indian rupee debt or a foreign currency debt under the regulatory regime, the tax rate on interest income would vary under domestic law. So it's 20% for foreign currency debt, and it's a higher rate for the Indian rupee debt. Having said that, under tax treaties, the withholding tax rate on interest is capped at 15% in some treaties, and another, if I take Mauritius example, it is 7.5% under Mauritius treaty. So again, there could be tax efficiencies depending on which entity is lending, which jurisdiction it is, and if it is eligible to claim treaty benefit, then the tax rate under the tax treaty could be lower compared to domestic law rates. Of course, there are eligibility conditions that one needs to fulfill. A significant advantage that a debt funding has over share capital infusion is that the company gets a tax shield in the form of interest deduction. It will be a tax deductible expense for the company where the debt is used for its business purpose. And the only point to note is that for an intra-group debt, Indian law has thin capitalization rules, which cap the deduction of interest at 30% of the EBITDA of the Indian company. It's an annual limit, so any excess can be carried forward for 8 years. This rule doesn't apply to a third-party debt. It applies when a debt is from an overseas affiliate or it is guaranteed by an overseas affiliate. So with that, I'll hand it back to you, Samir. Thank you.
Thank you very much, Ritu. Now let's move to limited liability partnerships. And these are also bodies corporate with legal existence separate from their partners. A limited liability partnership can be incorporated with a minimum of 2 partners, and there is no restriction on the maximum number of partners. However, every LLP is required to have at least 2 designated partners, and at least one of them is required to be a resident of India. Foreign investments in LLPs are permitted under the automatic route if the sector in which they operate is open to 100% foreign investment and has no FDI linked performance conditions. The liabilities of partners are limited to the extent of their capital contribution, or if there's any other contribution specifically agreed in the partnership agreement. And from a compliance perspective, an LLP structure works very well because the compliance is incredibly light. There are no specific management requirements. There are no fetters or restrictions on the various kind of transactions that an LLP can enter, compared to a company where you have to look at related party transactions or restrictions on providing loans and guarantees. And there are some incremental restrictions when it comes to overseas debt financing of LLPs. But again, the distribution of income is relatively simple, and it is also governed by the LLP agreement itself. Next slide, please. I would like to share the story of one of our clients, which is a renowned company in the animal husbandry sector. Their experience, in fact, exemplifies how a limited liability partnership can be very effectively used to serve the business purposes of foreign clients. This LLP was incorporated in India to support their growing business, which was primarily through government contracts and tenders. This strategic move has proven to be highly beneficial for several reasons, but if I simply name two, the first is that the structure offered tremendous flexibility in management and operations. It didn't have the complexities otherwise associated with traditional corporate structures, and this has enabled them to focus on their core competency, which is to provide solutions to the animal husbandry sector. Secondly, and more importantly, the LLP framework has still provided limited liability protection to its partners, safeguarding their global assets from the Indian business liabilities. Of course, this LLP was incorporated at a time when companies had the additional element of dividend distribution tax, but they have also enjoyed the benefit of repatriating profits very easily. Over to Ritu to discuss the tax considerations of LLPs.
Sure. So for an LLP, the headline tax rate is 35%. Unlike companies, LLPs are not subject to concessional rates. But the key structuring or a distinguishing factor between a company and an LLP is that share of profits distributed by an LLP to its partners is an exempt income. So there's just a one-time tax on the profits of the LLP at 35%, and there's no further tax on distribution of those profits to the shareholders. Now, in those times when corporate tax rates were high, there was a distribution tax on the companies. LLPs were viewed as a natural preference because LLPs were far more tax efficient compared to a corporate structure. That analysis has changed now. There could still be marginal tax saving in an LLP structure versus a company structure, or vice versa, depending on where the shareholders are. If the shareholders are residents, that's a different analysis. But for non-resident shareholders, if they are US shareholders versus, let's say, Singapore shareholders or UK shareholders, the tax cost of dividend repatriation would differ depending on the jurisdiction because of the different tax treaty rates. But overall, the saving will not be too substantial compared to a company structure. And like companies, LLPs are also subject to alternate minimum tax basis their accounting income, but it's not applicable to all LLPs. It's only applicable to those which are claiming certain specified deductions. Over to you, Samir.
Thank you. So maybe let's switch from incorporated presence to unincorporated presence. Next slide, please. Thank you. A non-resident may also set up an office, which could be in the nature of a branch or a liaison or a project office in India. A liaison office typically acts as more of a representative office of the parent company. But a branch office is a little more involved. It is essentially an extension or establishment of the parent entity, and it is allowed to carry out the same or substantially the same activities as its parent company. A project office is a slightly lesser cousin because it's permitted for specific projects to be undertaken by the multinational company in India. We spoke briefly about the automatic and approval route while discussing subsidiaries. In cases where the principal activity of the parent entity falls within the automatic route, the application for setting up an office is considered by the authorized dealer bank. In certain cases, such as non-profit organizations, etc., the authorized dealer bank will still turn to the Reserve Bank of India for its blessings before giving an approval. Nevertheless, if the principal business of the parent entity falls within the approval route, in that scenario, the application for an office of this nature will be considered by the Reserve Bank of India in consultation with the central government. This approval will also be required in certain sensitive sectors such as defense, private security, information and broadcasting, and so on. In addition to this, ladies and gentlemen, ordinary partnerships, which are distinct from limited liability partnerships, are also theoretically available. However, foreign investment in ordinary partnerships requires prior government approval, and these business forms provide for unlimited liability of the global business. As a result, these are used very, very rarely for conducting business in India by foreign investors. Ritu, would you like to run through the tax consequences of unincorporated presence?
Sure. Thanks, Amir. So in terms of tax consequences, since these offices will not have a separate legal entity, these will be just an extension of the parent company in India or the head office in India. These will be deemed as taxable presence or a permanent establishment of the head office in India, subject to nature of activities. So under tax treaties, generally there is an exclusion for preparatory or auxiliary functions. For example, non-core business functions or functions which are more preparatory to the core functions. So simple example could be market research before entering India, or acting as a communication channel between customers and the head office while not participating in any income generating activity for the foreign entity in India. Given that, because of the nature of a branch office or a project office which are actively involved in the business operations in India, these two offices will be deemed as taxable presence. But if we look at a liaison office which is set up only for communication purposes, market research purposes, they are not under regulatory regime allowed to participate in income generating functions. These offices should not be deemed as a taxable presence. Having said that, there have been scenarios where tax department looked at the functions of liaison offices of MNC giants like GE Energy, Hitachi, and these companies are selling goods, products to Indian customers, and they had their liaison offices in India to act as a communication channel. But when the tax authorities conducted search survey proceedings on their offices, they got access to email communication within the teams sitting in India and overseas, and they conducted interviews, and basis that whatever information they gathered, they figured that the India teams are participating in core sales functions, they are negotiating with Indian customers, and therefore they are not just doing preparatory functions. So it's, while of course it's possible to set up these offices to carry out, the limited functions, but India teams need to understand where to draw the line, and tax officers could get access to even the internal email communication. So I think regular training of teams on ground is very important, where they are told what is permissible, what is not, a standard list of do's and don'ts help, so that they know that they can't participate in negotiations with customers, concluding contracts with customers, etc. In GE Energy case, for example, the liaison office was treated as a taxable presence of 24 overseas entities. So the implications could be far-reaching. There could be interest, penal consequences, and then all your past years are kind of, subject to tax scrutiny. In terms of consequence, profits attributable to these offices or a taxable presence are taxable in India at the corporate tax rate applicable to foreign companies. Until last year, this tax rate was about 40 to 43%, but now tax rate on foreign companies has also been reduced, and now the effective rate is about 38%. Any repatriation of profits to the head office is not a taxable event, is not subject to additional taxes. MAT, book profit-based MAT, applies to foreign companies having taxable presence in India, so this is also relevant. In terms of profit attribution exercise, that's a key element of the overall analysis. because there are no objective criteria as to how to compute profits attributable to these taxable presence or these offices in India. One needs to generally follow arm's length pricing principles and do a benchmarking analysis to see that if a third party were to carry out these set of functions, then how much income is attributable to these functions by treating the permanent establishment or an office as an independent entity. And there's a whole lot of subjectivity there. You need to have the right set of advisors carrying out the attribution analysis, because the onus is always on the taxpayer to prove that yes, this is correct. If tax officer finds any loophole with that, then it will have to be demonstrated that yes, it is robust, all the assumptions are correct, etc. And lastly, since office has no legal entity, the tax registrations, tax filings, tax payments will all be done by the parent entity in India. So in many cases, if let's say otherwise the preference is to set up an office, but if foreign companies or clients, they do not want to be exposed to India tax risks or filings directly, they may prefer an incorporated structure over these unincorporated forms. With that, handing it back to you, Samir.
Thank you, Ritu. That was interesting. If we now move to joint ventures, and maybe what is a joint venture? It clearly represents a collaborative approach for the foreign investor to partner with an Indian party. This partnership will allow both parties to combine their strengths and resources and hopefully create a very robust foundation for what are likely to be successful business operations in a very diverse and dynamic Indian market. A lot of foreign clients who have entered India for the first time, as a part of their market access, have indicated to us that India can be very daunting due to, let's say, unfamiliarity with the local business environment, consumer preferences, the regulatory frameworks. So joint ventures offer the strategic advantage where foreign investors will access this local knowledge and expertise. And this collaboration will significantly enhance their ability to navigate these complexities and hopefully ensure a smoother and more successful entry. This also allows them to share the risks with the local partners because both of them will pool their resources and investments. And both parties can mitigate the financial and operational risks associated with the market entry and expansion. And this shared approach will reduce the burden on any single entity and fosters a slightly more cooperative environment. Interestingly, and most importantly, there are several sectors which do not permit 100% foreign ownership. Um, in such cases, insurance is a classic example of how foreign investors have partnered with Indian partners and over time gradually increased their stakes as the regulations have permitted them to do so. And in such cases, forming a joint venture with a credible and stable Indian partner has become not just beneficial, but in fact necessary. And this regulatory framework ensures that foreign investors are still able to participate in the gains to be had from these lucrative sectors, but they're still complying with these local laws and regulations. Having said that, and we will share one experience of a challenging joint venture, the success hinges on very careful planning and structuring. It is very crucial to establish very clear objectives, governance mechanisms, and the roles and responsibilities for each partner. This will also help you anticipate and perhaps proactively address potential areas of conflict and indeed aligning with the strategic vision of the joint venture, which itself may be a little different or maybe divergent from both the parties' interests. This will also prevent at the outset any future misgivings or misunderstandings and hopefully ensure a very harmonious partnership. So while we talk of legal due diligence and financial due diligence, perhaps a business level due diligence and a well drafted joint venture agreement are very essential components in this entire process. In certain sectors such as infrastructure, an unincorporated joint venture may also be explored, but this is again very specific to short term or project specific requirements. So in conclusion, a joint venture between a foreign investor and an Indian party will offer a very powerful strategy for entering and hopefully succeeding in the Indian market. On the next slide, we will talk about a very positive joint venture which we've seen develop over the years. In particular, this is, next slide please. I would like to highlight the positive response to Starbucks' joint venture with the Tata Group. Since its inception, Tata Starbucks has very successfully blended their global coffee culture with Tata's very deep-rooted understanding of the Indian market and the Indian consumers' preferences. This partnership has been met with incredible amount of consumer enthusiasm, and this just goes to show the perfect synergy between, let's say, quality coffee and exceptional service. It has expanded rapidly. They have over 200 stores across major cities, and really it resonates very well with Indian consumers who appreciate both the premium coffee and beverage experience and also a tremendous commitment to community initiatives and local produce and local blends of coffee. This is a shining example of a very successful collaboration which has delivered growth and has delighted customers nationwide. Let's look at a negative experience on the next slide. And this is really the challenges faced in the unsuccessful joint venture, which was the Uninor partnership. This was between Telenor and Unitech. And despite a lot of initial optimism, Uninor eventually struggled with significant disputes on governance and funding. These internal conflicts hindered strategic decision making and eventually impacted operational efficiency. And compounding these issues was the external challenge of the 2G telecom spectrum licenses, which were cancelled by the Supreme Court in 2012. And this dealt a critical blow to their business operations and market presence. This experience underscores the importance, like I said, of alignment in governance and also being able to assess the impact of regulatory stability on the success of a joint venture. This Uninor case serves a cautionary tale for businesses to ensure that robust governance structures are implemented so that they can navigate regulatory landscapes deftly and with diligence. Over to Ritu to discuss the tax considerations of a joint venture.
Thank you, Sameer. So in terms of incorporated joint ventures, it will be a company, generally it will be a company in which JV partners will just decide what is their shareholding split, ownership split. So it's from a tax perspective, it's more straightforward. The company will pay taxes basis what we discussed earlier, and any dividend extraction will be taxable in the hands of the shareholders. The one key aspect to note in case of incorporated JV structures is in a scenario where instead of putting cash, the JV partner is, let's say, contributing assets in the form of IP, technology, know-how. In those cases, there is no cash coming into the company, but an asset. And under Indian tax law, there are certain tax valuation principles that apply to share acquisitions, and it needs to be ensured that a minimum price is paid so that there is no adverse or a deeming basis tax issue in the hands of the recipient of shares. So to ensure compliance, one would need to value the asset that's coming in and the shares that are being issued in exchange of that asset, and then ensure that the tax valuation principles have been complied with. Extending the same transaction scenario, if let's say instead of contributing the asset to the JV, the arrangement is such that the non-resident is extending a long-term license to the JV, for which the JV is paying a lump sum royalty upfront, but not in cash by way of shares issuance. In that case, the deduction or the recognition of royalty expense in the books of the JV requires tax evaluation. How will that be accounted for? Will the JV be able to claim a deduction of that royalty expense because business is not in existence today? Due to that technology infusion or licensing, the business will commence operation. So it's not in existence today. So all these nuances need evaluation in a JV structure if capital contribution or at the time of inception of the JV, such transactions or arrangements are envisaged. Unincorporated JV need more attention from a tax perspective because unincorporated JV is a contractual arrangement between parties where they come together for a particular business or a project. In that case, the association itself or the combination itself could be deemed as a taxable person. And if there is a non-resident party involved, then the tax rate could go as high as 38%. There could also be tax leakages on account of any transactions or services that one of the parties would provide for the purposes of the JV's business, because the AOP as a taxable person would not be able to claim a deduction of such cost, but it will be a taxable income of the AOP member or the party involved. So there is a double tax incidence on such arrangements. Given all of this, it's important to review arrangements, document them properly so that such risks are avoided. Now, what is an AOP and where care needs to be taken is law does not define what an AOP is. The principles have emerged over time from judicial precedents, departmental circulars. And in terms of some indicative criteria, if there is a combination where parties are coming together for a joint business purpose, if there is overlapping scope of work, liability is joint and several, both parties are sharing liabilities towards the clients, there is no clear distinction, and there is joint management. So all of these put together could indicate that it is an AOP, and therefore one needs to document the scope of work, how parties are sharing the liabilities, and how the management of the association would be. So these aspects should be kept in mind, and from a practical standpoint, these arrangements are common more in the infrastructure sectors, where entities come together to make consortiums for bidding and for project execution purposes. So there, these aspects do need a careful evaluation. Handing it back to you. Thank you.
Thank you very much, Ritu. Next slide, please. Ladies and gentlemen, we have a comparative analysis of the various structures. In the interest of time, we won't dwell on it any further, but we will leave this in the slide deck, which we will send to you. Of course, should you have any questions or wish to discuss something specific, we'd be very happy to address that. Next slide, please. With this, we come to the end of our webinar, and we will try and quickly summarize the discussion today. In the presentation, we discussed that the choice of business structure depends on what are your goals, what are your objectives from the business, how quickly do you wish for it to grow, how would you fund your business, how would you scale the business. Each of these structures and avenues have different tax implications, both in India and presumably in your home state. The regulatory landscape for each business structure will also vary, and this needs to be part of the bespoke solution that fits your requirements. And also, while we talk of entering India, given we have exchange controls, given we have a regulatory environment, your potential exit, if it is relevant, then you need to be mindful of that as one amongst your various considerations. Each structure will have different control mechanisms, and we discussed with an example how a lack of clarity may even snowball into a dispute. So all of this, ladies and gentlemen, requires quality advice from quality and experienced advisors. Over to you, Prasanjit.
Excellent. Thank you, Samir and Ritu, for a wonderful presentation. It was so informative. And unsurprisingly, we've got a lot of questions for both of you. And I will maybe kick off with Ritu. Ritu, given the tax differences between a company and LLP, do you have a general recommendation on which form of entity is better from a tax perspective?
Thanks, Amir. So from a tax perspective, it's difficult to, of course, give a standard answer to this question, but let's look at different scenarios. Let's say you have a non-resident looking to set up an entity in India, and the investor is from US. In that case, a corporate structure could be slightly more, could entail slightly more tax costs on a combined basis, tax payable by the entity and taxes on profit extraction versus an LLP structure. But if we, let's say, change the US investor to a UK investor, then in a company structure, there could be slightly more tax saving compared to an LLP structure. And like I explained earlier, in those years when the corporate tax rates were high, there was high distribution tax. There was a significant saving in the two entity forms. LLP was better because of no tax on profit extraction. But under current law, the tax saving is marginal. Sometimes, depending on jurisdiction of the non-resident, company may be better in some cases, but marginally. And similarly, in other cases, an LLP could be better, but marginally. So I think now it's an overall assessment that needs to be done. For example, if let's say the goal of the business is to extract profits on an ongoing basis, in that case, maybe LLP could be favored because there is no tax on profit extraction. But if that's not the goal, if the profit or the money needs to be churned in the business itself, then a company structure may be better because on an ongoing basis, you have the ability to pay tax at a lower rate of 25% versus 35% in an LLP. And just to add, if let's say the owners are residents or substantial ownership is with residents, then the analysis completely changes because for residents, dividend income is taxable at high rates. The tax rate could be 39%, 40%. So for them, an LLP structure should naturally be preferred. So it all depends on where the investors are and what is the ongoing mid to short to long term goal with respect to India operations.
Thank you, Ritu. That makes sense. No one size fits all. Samir, turning to you, same question, but from a non-tax standpoint. Does one size fit all, or what's your response to which structure is viable or most preferred?
I think that's not an easy one to address, Prasanjit, but really the difficulty is less to do with the structure. It's more to do with whether clients know exactly what they will do for the life of the structure. What happens in an LLP, the examples that we discussed, there are only certain businesses that you can undertake. If you want to change your business line or add an additional business line, then that may be challenging depending on the regulatory policy at that time. There are also challenges in terms of transferring an LLP to another resident or non-resident who may have different aspirations for the business. And converting an LLP to a company also comes with its own set of tax costs which need to be considered. So I would say, unless you're absolutely certain, the client example that we gave as a part of the presentation, unless you're absolutely certain that there's one set of services you will pursue, that's your clean and clear business model. You won't look for external funding. You're happy to just through internal accruals run your business, then perhaps an LLP may work for you because it's easier from a compliances perspective. So there is a marginal tax saving, like Ritu said, and compliances wise, it's easier and more flexible. But if you will respond to times and evolve with times, then perhaps a company structure is far more time tested and well known, because we've now had companies in vogue in India for the better part of, let's say, 8 decades. We've had 2 laws, they've gone up and down. There's a certain level of understanding with that corporate structure. So if there is an uncertain future, there's an uncertain end to it, I would rather say, rather than experimenting with an LLP, go with a company.
Right. I tend to agree with that. So I think that should be helpful for our audience members. I think, Samir, you touched upon conversion of company or LLP or vice versa. Ritu, this is for you. So many times we have also seen that many clients are exploring the opportunity of taking tax benefits and look to convert an existing company into an LLP. Or as Samir said, companies offer some benefits and maybe they set up LLPs, they want to go back to company. How prudent is that, and how easy or difficult is that? What are the challenges from a tax standpoint?
Sure. So on the question whether it's possible to convert and will there be a tax cost? So answer is a tax neutral conversion is possible of a company into LLP or LLP into company. There are of course certain conditions. For example, company converting into LLP, the conditions are more favoring small businesses. So there are certain turnover linked conditions, asset based linked conditions, which a smaller business would likely fulfill, not a larger company would not be able to fulfill those conditions. And for LLP to company conversion, again, there are some lock-ins. Partners can't completely exit for up to 5 years of conversion. So subject to that, those conditions, conversion is possible. And we did see, this being picked up when LLP regime was introduced. A lot of companies were wanting to convert. And now, like I said, the tax analysis has changed. So now clients may be wanting to convert back to, a company structure. But I should add that Indian law has anti-abuse rules. So whatever step is taken to save taxes, that should be supported by well-documented commercial and business reasons.
Right. So doable, but one has to be mindful of some of the potential. Samir, turning to you, you talked about joint ventures. So what are the most common sticky issues in joint ventures based on your experience, which you can share with our audience members?
I would like to say, Prasanji, there are primarily three issues which I would raise. One, of course, is decision making, and whether is it my word against yours or would my word prevail. It's really that deadlock situation. How do you address it? Because historically there are a lot of Western solutions on deadlock, such as buy, sell, Russian roulette. All of those we've tried, but there have been instances where it's been possible for parties to engineer a deadlock and thereby somehow force the other party to give you an exit. As a result, in most instances, the way of legislating a deadlock is by not legislating it at all and letting parties' good faith and business sense prevail. So it's very important for you to know your business partner. Can you trust them to behave rationally in the event of a disagreement? And therefore, the decision making is, for me, public enemy number one. I would say number two, and taking a leaf from the Uninor situation, is having a clear business plan going forward, knowing where the funding will come from. Do you need debt? Do you need equity? Do you need third party funds? Do you have clarity on what is the roadmap? That's incredibly critical, because without that information, if you don't have that discussion today, believe you me, in 3 or 4 years, you will be down back to the drawing board saying, well, we've grown the business thus far. How do we go from this place to the next level? And I would say the third really is having clarity on exit. Because in most cases, joint ventures do involve at least one party who has a comparatively short term view on the joint venture compared to the other. In that scenario, are they able to sell to competitors? Are they able to sell to third parties? Should your partner have preference? All of those are very heavily negotiated and debated clauses in any joint venture scenario. So I would say these three: control, funding, and exit. These three to me are the most tricky ones in any joint venture on a sector agnostic basis.
I completely agree. I think these three are often the most troublesome issues and needs a lot of attention. Ritu, turning to you, this is an interesting question which has come up. So, in a scenario, let's say where a foreign entity, for business reasons, wants to set up multiple entities in India. So, from a tax standpoint, will you recommend a tiered structure, or will you recommend that a single foreign entity is the holding company, which then sets up these Indian entities? So what would be your response with reasons?
So I think answer to that will be a mix of tax and again business objective or goals. So let's take a situation where the companies are set up as in a tiered manner, right? So shareholders on the top, let's say there's company A in India, company A owns company B in India. So when we talk about profit extraction through the structure, when company B distributes profits to company A, it will be taxable income of company A. When company A distributes the same profits to its shareholders, it will again be taxable in the hands of the shareholders. This double taxation or cascading effect of dividend taxation at two or multiple levels, it can be avoided, but for that one needs to ensure that dividends are distributed in a time bound manner and there are prescribed time limits for that. So if company B distributes to company A and company A within the prescribed time frame distributes dividends to its shareholders, the double taxation of dividends can be avoided. So even here, if they can time these steps properly, pay attention to it, a double taxation of dividends can be avoided. But let's take an exit scenario. Let's say if the company A, company B are in different business verticals, and tomorrow there could be a potential opportunity where the two can be sold separately. In that case, if let's say company A sells company B first, it will incur a capital gain tax cost. And if those funds need to be upstreamed to the shareholders as dividends, then again a tax leakage. So these issues can be avoided if let's say the companies are two sister companies where dividends paid by each will be taxable only once in the hands of shareholders. Both can be sold separately. But if the business is such, nature of business is such that both are integrated and one won't foresee a situation that two needs to be sold separately and you'll sell it as a single piece, then maybe company A, holding company B also works fine, because then shareholders can just exit from company A and as part of that company B also moves. So combination of tax and legal would decide. But in both the structures, tax leakage on exit could be an issue, but dividend upstreaming they can still manage from a timing perspective and avoid double taxation.
I'll also add to what Ritu just said, Prasanjit. Sometimes in an acquisition scenario, we've seen clients, if they already have an existing Indian subsidiary and there's an acquisition potentially, you could always acquire directly below your global entity. But then you're left with two entities, additional administrative hassles for both. And like we said, winding up entities is very difficult. Then you traditionally look at a merger. If you're merging two sister companies, you'll need to go back to the national company law tribunal. But if we do company B below company A, there is a short form merger which you may be able to leverage. So we've also seen some clients, depending on that basis, as I'm sure, decide whether or not to have A below B or A and B as sisters.
That's helpful. I'm mindful of the time on the clock. So maybe one last question, Samir, before we head towards the conclusion. So you again, I think, touched upon during the presentation just now that winding up of entities is tough, and branch office is an option which we have talked about. So one question which has come is why is a branch office a temporary solution? Why can't be a long-term solution where you keep on extending the license for branch office and sidestep and circumvent the challenges of liquidation and all? So why can't it be a long-term solution?
So I would say there are 2-3 reasons for it, Prasanjit. One is there are some limitations on what activities it can undertake. So if you want to diversify your activities in India, the branch office will always be subject to doing something same or similar to what the parent entity is doing. The second will really be you can't really scale the operation significantly because then you're inviting more liabilities, and each of those liabilities you're inviting on the parent company's balance sheet. So theoretically, sure, you could continue to renew the validity of the approval and continue to do what you're doing, but most businesses like to do more than what they've done in the past as opposed to doing the same as they did before. So which is why we see clients who are dabbling waters will start with a branch office perhaps, but over time, once they are sure of the market opportunity and the size and scale they wish to achieve, they will flip either to a subsidiary or a joint venture or whatever else works for them. So it is to that extent, out of experience, we see it is at best a temporary solution.
Right, right, absolutely. I think so. I think with that, I think I would like to now, kind of thank our presenters for sharing their expertise and experience with us today. I thought they did an outstanding job. Thank you so very much, Samir and Ritu. Also, thanks to our audience for your attention and questions. We hope that you have enjoyed this webinar and found it to be a worthwhile investment of your time. You can see earlier editions of Investing in India webinar series on Khetan's YouTube channel. If you have any suggestions for future webinar sessions, please let us know. If you have any questions arising from this webinar, please do not hesitate to contact us. Our contact information is on the contact slide at the end of this webinar. After the webinar, we will send you a copy of the presentation with a recording and a summary notes for your consumption. You will also separately receive a request for your feedback on the webinar. Please take the time to send us your feedback. Comments, criticism, compliments, all are welcome. The format barely take a minute to complete, so kindly do the needful. Thank you for your attendance today, and we look forward to being with you again at future Investment in India programs. Have a good day.
Thank you very much.